but there's not been much focus on the retention tax credit. And this is something important for everyone to look at. Now, as Dean mentioned, we've had a 12-year excellent experience with Adelman, Katz, and Mond, specifically with Warren Bergstein and Jack Gold, both senior CPAs at the firm. Over the past 12 years, we've had annual tax updates every January, and they've enlightened us to how we can reduce or defer tax burdens, and unfortunately at times, what is going to be on the agenda to expect to pay more. So given this fact that we're talking about not energy, not investments, but we're talking about investment in human capital. And that's extremely important right now, given the last 15 months that we've been surviving in. So really, without further ado, I'll introduce Warren Bergstein and Jack Gold, who will speak to us about the energy tax credits and some other salient topics.
Thank you, Ed. I'm Warren Bergstein and partner at Adelman, Katz, and Mond. And Jack Gold will be speaking in a little while, my partner at the firm. We are talking not about energy tax credits, Ed, but the employee retention credit. I want to mention as we start out here that there's one difference from all the credits Ed mentioned and this credit, and that is this is not a credit against the income tax, unlike all the other credits. This is a credit that is taken on the payroll tax returns, the Form 941s that are filed quarterly, and is one of the reasons why it is so missed and so often forgotten about, and why it is so important that you're all here today to hear about it, because it is not being claimed as frequently and as often as it should be. So this is a very important seminar for you to be listening to. So Jack's got the slide control, so I'll ask him to advance the slide to the next one, and actually the next one after, because this is just us. And we can I'll put in our chat room later our contact information if you would like to reach us at any time. So the Employee Retention Tax Credit, the ERTC, which if you were looking it up, you might find you have to look it up under ERC without the word tax. It's interchangeable. One of the reasons the IRS doesn't leave the word tax in there is because of the implication that it would be a credit against the income tax, and it is a separate credit payroll tax on the payroll tax return. The other thing about this credit and many other things that happened as a result of COVID, as Dean was mentioning before, is that there basically have been a number of legislative changes in the course of only the year and a half or so that we've been dealing with COVID. So originally Congress got together and almost in a rare nonpartisan type of basis passed the CARES Act at the beginning of the pandemic. And the CARES Act is what established the employee retention tax credit. And the purpose of the credit is to encourage businesses to keep employees on their payroll. We often get calls, and I get calls very often actually, from small businesses that don't have employees on their payroll. They're sole proprietorships, and they have the kids working with them. They don't really pay a payroll, or whatever the case may be, or they just run their own shop. There are even law firms and accounting firms where they just don't have staff and don't pay payroll. And nothing me or Jack say for the next 32 slides will be important to those people, because without payroll, there is no ability at all to take a credit. The other way to look at it is if you don't file a quarterly Form 941, there's no ability to take this credit. But if you have payroll or you had payroll, this credit was designed for you to keep people on the payroll. So if, for example, a firm, an accounting firm, law firm, or any other firm had a receptionist prior to COVID, that receptionist in all likelihood doesn't have anything to do with nobody showing up at the office. This encourages firms to keep their receptionist on, give them some different responsibilities, and they keep their job and you get this credit and everybody's happy. So, and it's a shame that a lot of companies did not take advantage of the PPP loans or the credit in order to keep their employees on, because obviously the unemployment rates went sky high during the pandemic, and might not have had to if people took more advantage of these programs that the IRS and Small Business Association put into effect. The act was further amended by what's known as the Taxpayer Certainty and Disaster Tax Relief Bill, which actually was part of the Consolidated Appropriations Act, neither of which probably means a lot to most of the people watching or listening. It's not as popular a bill because all it really did was extend a lot of previous provisions in the law. So it really didn't create anything very new. There's no new law created. It's just that a lot of things were extended, and I'll be talking about today in the first 15 slides or so are the things that were specifically extended relating to the employee retention credit. I'll also mention that that same act, the Consolidated Appropriations Act, also further extended the ability to use this credit all the way to the end of 2021. Yes, Jack. So originally the expiration would have been June 30th, 2021. And our seminar might have been close to being too late, although not really, because we still have to file second quarter returns for this year. The credit is 70% up to $10,000 in wages per quarter for the year 2021. Now that could be a surprise to a lot of people because, as we'll find when we get to some of the next slides, that amount was only 50% up to $5,000 for the prior year, for 2020. The other good news is that originally in the provision, you had to file these credits timely on quarterly tax returns, and under the 2021 tax bill, you are now allowed to amend your 941s from last year. They actually created a new form called a 941X, and that 941X can be used if you didn't claim the credits in 2020, you can go back and claim them. So there is one of the questions that might come up. We did not spend a lot of time here on the PPP loans because I know that Megan and Ed and Dean spent a lot of time on the PPP and have been very involved with the PPP loans. But just to be clear, you can do both the PPP and the employee retention credit. You just can't do it on the same wages. So in other words, if you used your first $10,000 of wages already in 2021 for PPP, you can't use those same wages for this credit, but you can still claim the credit. The fact that you did PPP doesn't change anything. And again, this slide just repeats that we can use this all the way through the whole year 2021. For calendar year quarters after June 30th, 2021. These are the provisions. Certain startup businesses which began carrying on a trade or business after February 15, 2020 are now eligible for $50,000 per quarter if all the other eligibility, even if the other eligibility tests are not met. Your annual gross receipts cannot exceed $1 million. I'd like to hope there are people on the line whose receipts exceed $1 million and therefore can't use this, but more likely we're talking about small businesses where receipts don't exceed $1 million. Employees of all sizes can take this credit as long as their gross receipts are not more than 80%. That's a typo in this particular slide. And fortunately, there's another slide further, we'll see in a few minutes, that corrects that. So it's 80%, not 90%, compared to the same 2019 quarter. Now you might wonder why 2019, and the reason is because everybody knows that 2020 was a terrible year for most businesses. So your comparison is to the 2019 quarter to see if you're eligible. And in terms of doing anything wrong, we're not here to encourage you to do anything wrong. We hope you'll do everything right. But you should know that the statute of limitations on this credit has been extended from 3 to 5 years, meaning that the IRS or the SBA have additional time to be able to review these claims if anybody tries to do something that's not correct. So obviously, Jack and I are here to tell you what the correct rules are, and obviously those are the only ones you should be following. So there's a group I'll be talking about called qualifying employers, and then Jack will be talking about qualifying employees. So that's where the credit starts to get a little more complex. And again, one of the things I'm hoping we can encourage you from all of this is, despite the fact that we really can't make this any simpler, because it's just not really simple. It was made in a complex kind of way. Obviously, the purpose of the credit, again, is to encourage businesses to keep employees on and so forth. But they also did want to discourage businesses that really don't need it from asking for it. And that's why the complexities are added. So there are qualifying employers, and then there are qualifying employees. So I'm going to go through what is a qualifying, what makes an employer qualified for the credit. Employers who fully or partially suspended operations during any calendar quarter in 2020 or 2021 due to any orders from an appropriate governmental agency are able to use this provision automatically. So in other words, nothing, you don't have to know anything else. You don't have to go past this slide. If your business was fully or partially suspended because of an order from a government agency, and of course that's going to include a lot of travel, cruise ships, and so forth, you qualify. My next two slides don't matter, you qualify. Of course, then if your business continued or your business stopped because you just decided that it wasn't worth opening your doors, but nobody told you you couldn't, then you have another set of rules, and they're slightly different for 2020 and for 2021. So for 2020, employers with revenue in any quarter of 2020 that was less than 50% of the revenue when compared against the same quarter of 2019. You're a qualifying employer. Or employers of any size, including tax-exempt organizations, are eligible, again, if in any quarter of 2020, your revenue was less than 50% compared to the same quarter in 2019. It does not apply to government entities. For 2021, the next slide, again, here's where I corrected that bad typo from the slide 6, which Jack pointed out to me this morning. Thank you. For 2021 employees with revenue in any quarter of 2021, that's less than 80% of the revenue when comparing it against the same quarter in 2019. So as you can see, for 2021, a lot more businesses are eligible. One of the things, and maybe I don't want to be too political here, but you might be saying to yourself, why in 2021, when everybody needed it so much in 2020, did they suddenly do this in 2021? Well, 2 reasons. Number one, again, there are probably some political reasons for holding off until 2021. But also just remember the Tax Consolidated Appropriations Act passed at the end of 2021. The vaccine was only just starting. It wasn't really a promise that we were going to be up to the amounts where we have vaccinated today. And businesses were really, really suffering at that point. And if the vaccine did not come out, my guess is that there would have been a lot of long-term suffering in this country. So this bill did come out just in time. So, and I'm saying it because in a lot of conversation, people are saying, why did they do this in 2021 when nobody needed it anymore? Well, this happened in December of 2020 when it still was very much needed. And if you were forecasting at that time, I don't think anybody would have been forecasting that 57% or whatever it is of all Americans have been vaccinated. And by the way, that also means that 43% of all Americans have still not been vaccinated, and children have not been vaccinated unless they're over 12 years old. So we still have a way to go before we're totally out of the woods. So any help we can get from the government, from the SBA and from the IRS is very helpful to small businesses. And Jack, just one thing on that slide, going back, employers that were not in existence in 2019 substitute 2020. The trick there is you might not have filed your 2020 return yet, which means like our clients, you probably should start putting some pressure on your accounts to get those 2020 returns done if you were not in existence in 2019. And I think that's pretty much happening across the board. And then the other thing about being a qualifying employer is that employers of any size can qualify. That includes tax-exempt organizations, colleges, universities, hospitals, and medical care providers. But eligible employers must maintain documentation to support the determination of decline in gross receipts. Again, remembering that this is something which at this moment in time, the IRS and SBA probably have absolutely no capacity to audit because they are so busy with all of this stuff, but they have been given 5 years to be able to look at it. So let's be good people and do all the right things and keep the right documentation and the right record keeping. And I think my last slide before I turn it over to Jack is to talk about just quickly continuing operations. If an employee's workplace is closed by a government order, but the employer is able to continue operations comparable to prior to the closure, requires its employees to telework, fully or partially suspending. None of those things really do hurt the ability to be able to take this credit. So there's no one who is not eligible to take this credit. If the employers are teleworking, if their work is portable, if there is a requirement that they must be in the workplace, or if they're transitioning to telework, all of those businesses still do qualify for this credit. And I think with that,
yeah, you still got more partial suspension.
the partial suspension. Yeah, Jack, on the partial suspension of trade or businesses, employee that maintains both essential and non-essential business operations. If it's more than nominal portions of the business are considered to be partially suspended, which does give you a little more opportunity to take the credit. So again, I think this is just going on and on to say that anyone should be reviewing whether or not they have the possibility of taking the credit. That brings us to what is a qualified employee. I was talking about qualified employers. Jack's going to talk about who are qualified employees, and Jack will go into a little bit more about how the credit is actually computed.
Okay, thanks, Warren. So step back 1 second before I go into this. Basically, everybody, in my opinion, for what that's worth, in the New York metropolitan area would qualify because of governmental shutdowns and everything else, because everybody was somewhat limited in terms of travel, limited to the number of people you could have in your office. I know that at one point we were only allowed to have 25%. Then we were allowed to have 50% and 75%. And now obviously we're allowed to, I think, have everybody we want. No masks. The whole mask thing is a bit confusing. To be perfectly honest, you wear it on the train, you don't wear it in here, you wear it there. But everybody probably qualifies from a business point of view, just from shutdown and limiting of your business, even if you were essential, because you still couldn't really do your business 100% the way it was. So that being said, one other thing is, at least I have to actually prove it, but if you didn't qualify for a PPP loan because you didn't have the reduction, especially PPP2, if you didn't qualify, or PPP 1 or 2, for that matter, actually, sorry, you probably don't qualify for this either. So that, so if your businesses didn't have any reductions, and there are quite a few, I have clients that really didn't, they qualified for PPP 1, they didn't qualify for PPP 2. Because PPP 1 was an easy one to qualify, because basically everything in March, April, and May, or April, May, and June of 2020 was basically shut. We were all, I don't care if you were essential or not essential, basically everything was greatly reduced. So now, qualified employees. Basically, you need to have employees. They need to be full-time employees. And for 2020, it was 100 or less in order to qualify. I'm assuming that anybody on this call, and most of the clients that I deal with, I don't really have too many. I mean, I may have some clients that have more than 100 employees, but certainly not when it gets to the 2021 credit, which is more than 100, would qualify. But employers with full-time employees greater than 102,000 can only qualify for the credit for employees during the specified periods of 21 that receive wages for sick pay or family medical leave. Again, I don't have too many clients that this applies to, and I have a lot of small business clients. But if you furloughed employees or they got COVID pay, sick pay, or medical leave, they still might qualify if they're over 100 employees. For 2021, this is where they increased it to 500. I don't have any clients in the area, and I've got clients that have millions of dollars of revenue that have more than 500 They don't qualify for the credit because the people that at this level didn't have any reductions. But employers for 2021 with full-time employees of 500 or less in 2019 can qualify for the credit. And again, you got to have it's qualified wages. And okay, let's go through. Again, it's the same kind of thing. If you have more than 500 employees, you can still qualify for wages on sick pay, family medical leave, or qualified COVID-19 related circumstances. Understand one thing though, if you apply for the credit and you get the credit, that's taxable income. unlike the PPP, because this is not a credit for income tax. This is purely a reduction of your payroll taxes. You will have to pay that's considered income. I know somebody that ended up getting over $1 million back on this because of this for 2020. Actually, didn't use it for 2020, but in 2021 for the first quarter, her company got back over $1 million, and they were willing to obviously take $1 million in less. Let's use a 40% tax bracket. They still ended up after all is said and done with about $600,000 in their pockets for the company. And they have an employment agency. That's why they're able to do it, because they have 500. They had less than 500 employees, but they were able to do this. They got a lot of money back. I only have one client that's asking about this now currently, though, by the way. Okay, the term full-time employee means an employee who, with respect to any calendar month, had an average of at least 30 hours per week, or 130 hours of service in a month. That's a full-time employee. If you were that operated its business for the entire 2019 calendar year, determines the number of its full-time employees by taking the sum of the number of full-time employees in each calendar month and dividing by 12. So you would add up and divide by 12. It's, again, these rules, like everything else that the government puts out, is never meant to be take A, take B, divide it by that. It's never in succinct, simple. Anybody who deals with taxes knows it's never meant to be simple. There's no such thing as tax. That tax simplification thing is a lie. Flat out lie. Nothing is made simple. Okay. If you started your business operations during 19, you can use different calculations in order to get this. I don't want to spend too much time going through how you do it, but if you have full-time employees, but an employee that started your business during 2020 determines the number of its full-time employees by taking the sum of the number of full-time employees in each calendar month in 2020 and divide that by the number of months that you were in business. So if you started your business for some crazy reason, somebody started July 1st of 2020, they would take their number of employees, full-time employees, which means the 30 hours or 130 hours, and add them up and then divide by 6 in this case, if you started July 1st. Somebody was brave enough to start a business July 1st. Although there probably were businesses, because there were opportunities for people to do certain things, because it's amazing what I've seen. And as an example, there's a business in my neighborhood that I've seen where the guy comes around and washes out your garbage pails. So you have clean garbage pails. Who would know? Who would think of it? But somebody did, and I saw him. I've seen him at 4 or 5 different houses. Now, you might think that that's a bit extravagant, but it keeps out unwanted visitors to your garbage pails, to say the least. Qualified wages are all wages paid to employees within the determined period, plus health costs. For 2020, it's limited to $10,000 per qualified employee per year. I'm emphasizing per year because there's a change in 2021 for this. And the credit's 50%. So when you look at this and you go back to determine, should we go back to 2020 to look at it, you need to say to yourself, well, you know what? It's A, from March to December. B, you're only going to get up to $5,000 of a credit. So you need to go back and look to see, because you remember, if you amend your 941s for 2020, you have to amend and report income possibly in 2020, or at least in 2021, you're going to have to report the income when you get the money. And again, the credit is 50% of qualified wages, which basically means $5,000. You also need to take into account of whether or not you used these wages for PPP. So if you used wages for let's say 26 weeks of 2020, which basically 24 weeks, excuse me, which is basically from July 15th to December 31st, or wherever you used your wages. Most people would have used their wages, let's say from the middle of May through October for PPP money. You can't use those same wages for this credit. So you have to determine, did you have $10,000 and where it amounts to. Again, that client, that friend of mine who was a controller of an employment agency, didn't even bother going back. It just was too difficult to go back and split it up and figure out what wages were PPP and not use those, and then what wages were not. It was just, she decided it was just too difficult because she got enough money in 2021 that it mattered. Larger employees, larger employers, we explained that the full-time employees are subject to a government, again, suspending operations. There's a whole calculation. Again, I don't think anybody's going to have anybody on this call has too many larger employees. And if you do, you can let us know. Wages, it's the same 10, make sure 10% of the wages paid. I don't want to get into that. Okay, for 2021, I want to get to this because more people are going to find this. Wages are limited to $10,000 per qualified employee per quarter. So that means, and the credit is 70%. That means that you can get $7,000 for the first quarter, $7,000 for the second quarter, the third quarter, and the fourth quarter, as long as you meet the other requirements. Again, per quarter here, per year here. That's the biggest change. Well, that and the 70%. And specifically, it says wages used to qualify for forgiveness related to a first draw or second draw do not qualify. Also, if the only employee in the business is either you or your spouse or a relative, I don't think that qualifies as actual wages. You would need to have other wages. So let's say my firm, we have 15 employees and one of them was my son, that all qualifies. But if the only employee was my son, I don't think I believe that doesn't qualify. That was what somebody was mentioning to me. And it says if the employer's employment tax deposits are not sufficient, this is how to claim the credit, sorry. How to claim the credit. If your deposits are not sufficient, you can get an advance from the IRS. Somebody had to create a new form. Otherwise, you reduce the payroll tax deposits you're otherwise required to make. Or as Warren had actually mentioned, there's a new form for it because you'd have to go back and amend. At this point, if you're going to file based upon the first quarter of 2021 or the second, third, and fourth quarter of 2020, you need to file an amended return. And there's probably a new line on there, which I would have thought about that and gotten the form up, that you can get your money back. And as Warren had mentioned before, the statute of limitations is 5 years. I do expect probably that they will go after some of the larger credits they give back. I mean, if you only have one employee for $10,000 and get a $7,000 credit, I can't imagine that they're going to waste their time. And the thing that they're going to audit would be, do you have a reduction of income? Because there's nothing to audit on, the 941 says you paid somebody $10,000, you're going to get $7,000 back. Flat out, that's that. And I will have I have something that's not in the PowerPoint, a chart and a whole flow and a bunch of flow charts. Thank you, Megan, for reminding me that it was a flow chart. on this whole thing. So if an employer has 10,000 in qualified wages, resulting in 7,000 credit, employer's total withholding for all employees is 8,000. Employer may deposit $1,000 and retain $7,000. If your total taxes were $8,000, you would only deposit 1,000. You keep 7. So obviously that means that when you record your payroll and everything else, you're going to have $7,000 worth of effectively a liability that will not be paid, which then ultimately has to go away, which becomes income on the P&L on your tax return. Employers may file Form 7200 to request an advance payment. And 72, it should be done for each quarter. And Form 7200 may be filed multiple times during each quarter. So in other words, I didn't realize that. If you're paying taxes and as you go, you might be able to get the money back quicker. Okay. Form 7200 must be filed before Form 941 of the IRS. I'm not sure I perfectly understand how that works, but we can look into it. Again, I haven't done this form or done this filing, and I have only one client who's asking about it. And you're going to get a check. So unlike other deposits from the IRS where they can be done electronically, this is going to be a check. And they're talking about here that there's going to be a reconciliation that if you get an advance payment, you may have to pay back the money. Unlike the stimulus payments, where if you got the money based upon 2019 on your personal return, and it turns out that you shouldn't have gotten it, you don't have to pay it back. This is how you can do this, the 7,200 advance payment. Again, I don't know if you really need to get advance payments from prior years, but there is a notice out there, 2021-3, if you want to look that up under IRS notices, that will help qualify how this works. And there are questions, but before we do that, hold on. Here is, I got this from one of the payroll services out there called Gusto. I don't know, do I need to make it a little bigger? Do I need to make this bigger? Anybody, we'll make it a little bigger. Here is more or less is a simple chart, simpler chart. So March 13th, 2020 to December 31st, eligible employers must have between 1 and 100 W-2 employees, excluding the owners. Eligible businesses must have been in operation before. The maximum credit is $5,000 per year, and it's 50% of qualified wages. To qualify for here's that ERC, Employee Retention Credit, you must see a decline of 50% in gross receipts when comparing corresponding quarters 2020 to 2019. Remember, this is gross receipts, not in net income. Gross receipts. 2021, January through June of 2021, and remember, we still haven't gotten to June. We may not have filed you didn't file your June 2021 quarter. It's 1 to 500 W-2 employees, and here it is again, excluding the owners. Unlike PPP, the owners don't count. Eligible businesses must have been in operation before February 16th, 2020. That's the same. The maximum credit is $7,000 per quarter, or $28,000 per year. 70% of qualified wages as opposed to the 50. And you must see a decline of 20% in gross receipts when comparing. So here you might make it. I think then, yeah, 20%. That's the actual decline. So if you had $100,000 in the quarter, in any quarter, and in 2019, and you only had 75,000 in the same quarter in 2021, you qualify. And here you have quarters 3 and 4, which again, if you're doing this in 1 and 2 in 2021, you might make it here. Again, 1 to 500 W-2 employees. It is possible to be eligible if you started your business after February 15th, 2020, if your gross receipts are under $1 million. Again, under $1 million, the smaller, they're looking to help small businesses. They're looking to help those restaurants, those delis, those, clothing stores, the local mom and pop shops on main streets. Again, where it is. The maximum credit, again, is $7,000 with $28,000 per year, 70%. And you must see a decline in 20%. The other thing that I found here is, I always love flow charts, but you got to be able to follow the flow. You got to be able to follow the flow of the flow chart. If you were in business before February 16th, 2020, the answer is yes. Do you have 500 or fewer employees? Yes. And you could follow this through. But I do think you end up with the credit. You're eligible. Once you figure out that you're eligible and you end up not eligible if you had more than 500 employees, again, for tax year 2020, or if you're comparing your receipts down at least 50%, no, forget it, you don't qualify. Unless you are completely a full or partial shutdown, you might qualify. It gets very confusing as to whether you qualify or not in terms of these more so in 2020, I think, than in 2021. But again, everybody was shut down for the most part. March, April, May, June. I know we didn't open up Adelman, Katz, and Mond until after July 4th. We had people come back to the office. We're an essential workers, so theoretically we could have opened up sooner, but we were essential workers. I don't know, if I make this a little smaller, can everybody see this? Thumbs up by somebody?
I think it was better when it was larger.
Okay. So again, you were in business before, yes. Do you have 500 or fewer employees? Yes, you continue. No, you would go straight over to the right side, which takes you down to, sorry, goodbye. When comparing 2020 with the same quarter in 2019, were gross receipts down? No. Let's go with the no. And then you would come over to here. Was your business subject to a full or partial shutdown in this quarter? No, you're done. Yes. Did you pay out wages while your business was shut down? Again, if you keep answering no, you're done. If you answer yes, basically, if you're answering yes to these questions, you make it. You make it to the bottom. This is like one of those games where you drop the ball and it's got to go bounce around. But anytime you're answering no, you're jeopardizing whether you can follow along. So that's that. And this was done by Gusto. If your business is eligible in 2021, you would, again, were you in business before February 16th, 2020? Yes or no. If it's no, you may not be, you're not eligible. If it's yes, 500, and again, the more times anytime you get a question and answer no, you are basically jeopardizing, you're not qualified. You're probably falling into the non-qualifying place of business. And again, in 2021, it's going to be a lot harder to show full or partial shutdowns because in 2021, most things were open pretty quickly in January, February, and March. More people were open, at least to some degree. I don't know of anybody that was really still shut down. I guess a cruise ship, and I don't know if you were, the Mets, the Yankees, or the farm teams, but they weren't working in January, February anyway. So again, flow charts, it keeps following down. You can find these, and again, I found all of these online. It's too bad I couldn't create Google. Google would have been a good thing to create. But giving you everything. Again, 2021 third and fourth quarter is where it gets tricky. The thing to take, I think the biggest takeaway from this, from all of this, from this seminar and everything else, is to know that the credit is out there, to know that you could possibly qualify, and to assume somebody needs to be looking to see, do you qualify? Does it make sense to go back to 2020 and amend? Does it make sense to go back to the first quarter of 2021 and amend? And if you're following through with all of that for 2020 and 2021 first quarter, you probably would qualify for the second quarter of 2021, and then you would get the credit. Again, my friend got the business that she works for, she's the controller, got $1 million back, and it's free money. Well, free money to the company, effectively, even if it's net of taxes. Somehow or another, we all know that we're going to have to pay for this somehow. Somebody's going to have to pay for it. But I guess we'll have to worry about that as time goes on. With that, my part of the speech is, I'm finished. If anybody has any questions,